Welcome and good afternoon. We're glad to have you for this month's office hours. I'm Amy Auchmuty, Client Relationship and Development Associate, and I'm joined by Lead Wealth Advisor Dan Staus. If you're unfamiliar with Flagstone, we are a fee-only comprehensive financial planning firm. We seek to continually be a resource for sound financial information for others, as well as partner in helping you achieve financial goals to help make life meaningful for you. Today, we're discussing financial planning considerations as a business owner. We have blog posts that go into deeper detail that you can find on our website, www.flagstonefm.com. We'll also take any financial questions you have at the end of our time. As always, if you have questions after our webinar, feel free to contact us. Finally, Flagstone is a registered investment advisor, and information here is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial planner or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. All right, Dan, let's talk about things to consider as a business owner.
All right, thanks, Amy, for that intro. And I would add, before I forget, that some of the issues we're talking about today are also get into kind of the legal realm. So I'll probably mention that a couple times, but I just don't want to forget there's issues you'd want to consult with an attorney about here as you consider different business challenges or questions. Amy mentioned that we get a little more detailed in the blog posts that accompany this webinar. And we can, in the description of the video, we can list links out to those blog posts. But so we'll keep it kind of high level today. Just kind of picked a few of the most common questions that clients ask to us when they're business owners or when they're thinking about becoming business owners. And so we'll focus a little bit just on a few. It's still going to be pretty high level. Just as a reminder, these office hours are really meant to be a time when clients or other connections of ours can come and just ask us questions about really anything that's on their mind, much like office hours in the college setting where students can just go show up at the professor's office and talk to them about whatever they need help with. So to that end, we're going to do maybe 15 minutes or so of discussion around prepared stuff, and then we'll move to kind of Q&A. So with that said, let me share my screen and we can get started here. All right, the first topic that we're going to talk about is what type of entity is preferable or the best type of entity for the type of business that you're going to form. There's considerations on how much legal protection does it provide, what are the characteristics from a tax perspective, and then how complex is that entity to create, maintain, what are the costs of maintaining that or creating it. There's legal costs to creation, there's accounting costs to filing a tax return each year. So those are the main things to think about. There are others, but those are the ones that we're going to focus on today as we go through the list. The first and kind of the default and the most common entity type for a business in the US is a sole proprietorship. And I say the default because if you don't do anything formal to create an entity, that's what it's going to be. It's a sole proprietorship. It's really easy because there's really no administration involved. There's no separate tax return. If you have a business that is a sole proprietorship, that stuff is just going to flow through a Schedule C on your tax return. You don't file a separate return for that. Your business is you. Those are those are some of the characteristics that make it easy and preferable for some people, but there are disadvantages. There's no separate liability protection. So anything that you do that someone sues you for or you cause harm for, that's you're personally liable for that. It's limited to a single person, so you can't have multiple people have a sole proprietorship. And then it's not great for businesses who want to grow the business beyond themselves. Same deal with being limited to a single person. So you can always switch a business entity from sole proprietorship to something else, but there are some limitations there. Partnership is the simple structure for two or more partners. It's kind of the default structure. It's kind of like a sole proprietorship, except it's for multiple owners. One of the advantages is that limited partners. So there are different types of partnerships. Some partnerships have limited partners and general partners. If you're a limited partner, you do have some limited personal liability. Whereas if you're a general partner, you have unlimited personal liability. Anyway, it is kind of a simple and low cost option for multiple owner businesses, kind of like the sole proprietorship for the single person. So next up is a C corporation. There's really strong personal liability protection with a C corp. It's the most formal arrangement. There are no limits to the number of owners that you can have. So for businesses who are pursuing going public, or who want extremely strong liability protection, or who are okay with a lot of complexity, those are some advantages to a C corporation. Disadvantages is that there's double taxation. The corporation itself pays taxes on its profits, and then when it passes dividends through to owners, the owners pay tax on those dividends as well. So that's where you get the double taxation thing. They also can be complex. They're complex to set up, to administer ongoing. They are expensive from a tax preparation standpoint. So there's just a lot of extra stuff that you have to consider when you're a C corporation. S corporation is kind of the simpler form of a C corporation, and there's some major advantages of an S corp compared to a C corp if you can qualify to be an S corp. So there's still strong personal liability protection, but there's no double taxation. So the S corp itself doesn't pay any taxes, but the owners do. So the profits of the business flow through to the owners, and then the owners pay taxes on those profits personally. The disadvantage is that you have to qualify to be an S corp. You can't have more than 100 shareholders and still be an S corp. And then you're also limited to one stock class. That's different than a C corp, where you can have multiple share classes. Limited liability corporation, limited liability company is another option. There's personal liability protection. There's no double taxation. It's a pass-through entity, kind of like an S corp. There's flexibility in taxation. You can actually choose to be taxed as an S corp. You have other options though. There's unlimited number of shareholders, but it is more complex than a partnership or a sole proprietorship. And there's higher legal and accounting costs than a proprietorship or a partnership. So it's kind of in between that super simple option of a sole proprietorship or a partnership, and then the complex option of the C corp. So that's kind of summarizes the what type of entity should I choose, but really an accountant and an attorney would want to speak to that as well. When we talk about personal liability protection in particular, you'd want an attorney to help you understand what type of protection is even needed for your business. Is it a risky type of thing that you're engaging in with your business or not? If you're creating defense weapons versus if you're if you're crocheting blankets, like those are two very different things from a need for liability protection. So you'd want to talk with an attorney about your options there. And then a CPA or accountant could help you understand tax implications of your options too. Okay, completely shifting gears, adding employees. We do get people who have started a business and they're wondering, if I add employees, what is that going to look like for my business? What are some of the things that I should consider with that decision? Well, I have a really short list here of pros and cons, or advantages and different disadvantages. Some of these are financial, some are not really financial. But the first one I have there is it can improve work-life balance. If the business has grown to the point where you by yourself are just kind of consumed by it and you just need help and your work-life balance is completely out of balance, well, adding an employee can help. There's a cost to that, but maybe the benefit of being able to achieve a little more balance is worth it. You can focus on the business tasks that you actually enjoy doing. So you can outsource the stuff that you don't really enjoy and focus on the things that you're passionate about, the things that cause you to start the business in the first place. Third on the list, when you have more help, you can grow the business. If it's the right hire, then you can focus on growth. When you're focusing on the things that you enjoy, when you're delegating tasks that you don't, and then simply when you just have more manpower, then that can position you better for growth. And then lastly, it can help with the feeling of being alone in your business. So a lot of people who are just by themselves in their business report that they feel kind of lonely. They're doing this thing by themselves. They don't have someone else to bounce ideas off of, even if it's not like a partner or someone who's going to operate on the same level as you in the business. It can still help just to have someone alongside you to help with that feeling of loneliness or to be able to brainstorm or collaborate with in your business. There are disadvantages though. You're now a manager, so that's a big thing that a lot of people don't necessarily think about when they're wanting to form a business or wanting to add employees, but they're going to become a manager now. And is that why you got into the business? For most people, no, but it's a responsibility that you have when you're hiring employees. So think about how you feel about being a manager, changing your role a bit. It can negatively impact retirement savings options for you as a business owner. So for example, if you have a solo 401k, it's just a type of retirement account that a lot of business owners have. You've kind of been able to fund your own retirement as long as you have the profits to do it. You've been able to put a ton in there and don't have to worry about like discriminating against a employee. Well, when you add an employee, you're going to have to contribute. If you do some sort of profit sharing contribution, you have to do the same percentage to them as you do to yourself. So sometimes you have to consider those retirement savings effects. And then lastly, I mean, at least on this list, there's always the employee always the potential or the possibility that the employee isn't going to work out. So tough conversations about having to fire people, like that's the worst thing that a business owner has to go through. For a lot of people say that, at least a lot of business owners say that the worst things that they've had to do have been firing somebody. So that's always a potential thing to think about. There are also, like, going back to the advantages, notice that each of those bullet points start with the word can. Doesn't mean that it will improve work-life balance or help you grow the business. It's got to be the right person. And a lot of times when you make the hire, you don't know whether that's going to happen. But so anyway, that's just another variable. And then lastly, I thought I'd wrap up with a few effects on personal finances. What does business ownership do to your personal finances? And the first screen here is advantages, and then I'm going to move to disadvantages. And this certainly isn't an exhaustive list, but it's ones that we talk about a lot with clients. So first up, business ownership can help build wealth if there is value in the business beyond the individual. So when you think about a sole proprietorship, a business where it is just the person, oftentimes there really isn't a value there to the business. Like, in other words, if you die or if you retire, there's not a value that's going to go beyond you. However, if you're building the business and you're hiring employees or you're building a brand that kind of transcends you by yourself, there can be value in that. So if you're building this thing that has value, that's kind of a retirement savings vehicle. I wouldn't exclusively, I mean, some people do get into the the habit or the mindset that, hey, I'm just building this business value, and so I'm not going to contribute to retirement accounts. I'm not going to own stocks or bonds. I'm not going to worry about savings. I'm just building the value of my business, and that's going to be my retirement. Well, that works for a lot of people. It's also pretty risky, because if that value isn't there, or if it's not as much as you thought, your retirement savings is really dependent on the value of that business, and that's it. So it can be risky, but it can be an advantage if the business grows and does really well. The second on this list, a lot of personal expenses are also business expenses that you can deduct. That's another thing you'd want to talk to an accountant about, but all of a sudden, some things that you may already be spending money on might be effectively cheaper because you can deduct them through a business if they have some sort of business purpose. The third one, you get to keep your after-tax profits, as opposed to being an employee of a business and not being entitled to the profits of the business directly, or you have limits there. When you're a business owner, those profits are yours. If you do really well, that earnings potential is pretty big. Next up, a lot of business owners experience from just building or creating something beyond themselves. There's other reasons for fulfillment, like you might feel independent and you enjoy that. You might just enjoy the mission or the purpose of your work. But all those things can really, for some people, they're really wired to enjoy those things. I think as humans, the creating and the building something, it's kind of inherent to being a human, is we like to create, and some people really thrive on doing that through the business. There's others that, like I mentioned on here, maybe they're just super passionate about a cause or a mission of their business, and so they really find fulfillment from that. And so there's these other kind of emotional or non-financial benefits of it. Next, I have, you can create economic opportunities for other people or their families if you have employees. So going back to that, like, do I hire? Well, some people find fulfillment from just providing that opportunity of a job or an income for their employees. So last on this list, many retirement savings opportunities can be valuable for business owners. So, as an employee of a business who's run by someone who's not you are kind of limited to whatever they give you for retirement savings options. Whereas when you're the business owner, you can kind of choose retirement savings vehicles that have really big contribution limits, depending on how much profit you're generating. But there can be pretty big tax advantage vehicles for retirement when you are the business owner. That's what I have for advantages, and then I'll wrap up with disadvantages, and then we'll kind of move to Q&A. But okay, disadvantages. Starting a business is risky, and most businesses fail. I think Amy's blog article, I think you said some certain percentage of businesses fail within the first year. I don't know. Do you remember what that is off the top of your head?
I don't remember the specific number, but yes, it is. It's a higher number than you might think.
Yeah, it's like the majority. So it is risky, especially if you're putting money into it to fund the creation of that business. If you're just doing a service business that doesn't require a lot of startup costs, then really that financial risk is just no wages or no income for a period of time, of months or years. But if there's a lot of startup costs, there can be some bigger financial risks involved. The second one I have is there's no really established business to take care of you. If you're working for a big corporation or you're working for the man, there's plenty of disadvantages to that. But one of the nice things about doing that is that there is like a benefits package that's available. If you're working for a stable company, your job might be more secure. There might be opportunities to change positions within a company. When you're the business owner and you're starting your own thing, that just isn't the case. So that could be a disadvantage for some people. there is typically significantly more responsibility on your plate as the business owner, depending on the type of business and the type of role that you're creating for yourself. But really, the success or the failure is up to you, and so that's a big responsibility. And then last, I have some business owners who operate on their own report the loneliness or stress due to being the sole decision maker. So that kind of goes back to stuff I was talking about earlier with hiring employees can help with that. But that's a real thing for a lot of people. That's really all I had from what should I think about as a business owner? Again, because I kept it pretty high level, I only really focused on 3 topics. But check out our blog series for more things to consider. There's a ton that we wrote about the past 3 blog posts. So that'll go slightly more into detail, but more so just cause you to think about more things.
Yeah, thanks for that, Dan. One of the things I also want to mention, Dan referenced some of the retirement plans. We also have a blog series about that goes into much more detail about each retirement plan that you can check out on our website. Again, it's www.flagstonefm.com. So there's good information in those as well. As far as questions, we're kind of switching gears to what's very relevant to headlines these days. And so I have a few questions, Dan, that I would love to hear what you think. Of course, we talk about some of this stuff in the office frequently. It's on a lot of people's minds. And Dan will have a chance to share with our audience what he thinks about these. So the first question that came up was, what are your thoughts on the recent bank failures?
Yeah, that's been a big headline lately. The main thing people are wondering is like, is this similar to the financial crisis in 08 when there was a lot of stuff going on in banking that was concerning? But just generally, what are our thoughts? We're still confident in the U.S. and non-U.S. banking systems. There were a few banks that had some specific issues that were kind of magnified by how quickly interest rates have risen in the past year or so, year and a half. But we really don't think there's any systematic issues. There's a lot of big swings up and down with bank stocks right now because of that. And it's causing the Fed to wonder, should we be raising interest rates as quickly? This week they just raised by 0.25%. And the expectation is there may not be much in the way of interest rate hikes the rest of the year. But all that to say, we made some moves to get to a more secure or less risky money market account because of this. But beyond that, we're not suggesting that clients make any changes specifically because of this. So I think it'll kind of calm down in the coming months. I think there will still be some volatility, specifically in financial sector stocks in the near future. But long term, I don't think this is going to be a huge thing that people are going to write about it. People are going to remember it, but it's not going to be anywhere close to like what happened with financial institutions in 08, 09.
Yeah, and one thing we have mentioned around here is just ensuring that your accounts are in alignment with FDIC coverage as well.
Yeah, that's a good point. Yeah, the limit's 250. A lot of people don't talk about the fact that you can get more than that at one bank, because if you just title accounts in certain ways, like in a joint account versus an individual account, you can actually get more coverage. But yeah, you should review those rules and make sure that you're covered. If you're unsure, you can always talk to your banker.
Okay, great. You touched briefly on, and I wonder if you have additional thoughts, which it's okay if you don't, but there's a question that asked, will the Fed keep increasing interest rates? Do you have any additional insight or thoughts about that?
I can actually pull up a chart that kind of answers that. There isn't, to reiterate what I mentioned earlier, there isn't much expectation that interest rates will increase the rest of the year. That's actually really different than what we were thinking like 2, 3 weeks ago. This banking stuff has completely shifted the expectations. Prior to this banking stuff, the expectation was that rates would increase another maybe percent or so. It was like something between 0.5% and 1% before the end of the year. And now that has shifted quite a bit. Let's see if I can pull up yeah, here we go. I'll share my screen again. So here's the implied future Fed funds rate. And this can change quickly. So don't take this for like truth or what's going to actually happen. But the expectation right now, well, there was an expectation that there would be a 25 basis point hike on March 22nd, and that is what happened. But then there might be one more 25 basis point hike before the end of the year. And then the Fed would start actually cutting the interest rate. So the implied Fed funds rate by the time we get to December 13th is 3.97. Which is actually lower than what it's at right now. So that's kind of the math. Now, I mentioned that can change quickly. Like if that chart looked completely different 3 weeks ago, 2, 3 weeks ago. So anyway, that's kind of what markets are thinking. And I think that's just going to depend on what the Fed actually does is just going to be dependent on what do we see when new inflation data comes out? What about jobs data and unemployment data, in other words? Is this banking stuff going to settle down? Basically, the reason the banking stuff matters is because the Fed made remarks to the effect of this might actually reduce lending, which is going to theoretically, that lowers inflation, so we don't need to hike rates as much. That was one comment that they made. So anyway, I could continue talking about that, but that's kind of the summary.
Yeah, it's all definitely interesting, and there's so much at play that you're right, it can change very quickly. Thanks. And then one more question, is the stock market overvalued? What are your thoughts about that?
Actually, on the same chart book, I think I have a chart that could speak to that. There's something called a PE ratio. That stands for price to earnings ratio. And that basically means how expensive are stocks compared to the earnings or the profits of the companies that you're buying of those stocks. So let me share that chart with you. This goes back to the 90s. And that PE ratio, the higher the ratio, basically means the more expensive the stock is. Now, this is PE ratios of the S&P 500. So that's like a basket of large US companies. So historically, going back to the 90s, the average PE ratio has been 15.6. You can see that like there's a tech bubble. When the tech bubble burst in the early 2000s, it was as high as 24.5. And then when the financial crisis happened and the stock market tanked, at the bottom of that financial crisis, the PE ratios were really low at 9.5. And then they grew. We had this basically a 10-year, 12-year bull market. But then we've had recent pullbacks. And so now here we are at 17.3 PE ratio. So that's a little higher than historical averages. If you're looking at going back to the 90s, it's not crazy expensive though. I mean, I look at this chart and I'm like, hey, that's pretty close to what the average is. So we don't have expectations that the stock market is going to tank because it's overvalued, because that's just doesn't seem to be the case. We also don't have expectations that the market's going to have a huge increase in the near future, because valuations don't really support that either. All that said, PE ratios are just one of several things that tell you something about the stock market. And so the market could really take off and do well, and it also could tank in the near future too. So, but that's just kind of a ratio that can somewhat speak to that question.
Yeah, great. Well, thanks so much, Dan. And to everybody else, that's the end of our webinar, and we appreciate you joining us. Be on the lookout for next month's next quarter's topic, and we'll hope that you'll join us. Again, thanks, and we'll talk soon.
Thanks.